Hello, my fellow silver and gold stackers. Welcome back to Gold Rush Reporter, the place where we break down the real story behind silver and gold, without any hype, just clear facts and analysis. Today, we're going to talk about COMEX margin calls and why silver's price sometimes drops even when demand is high. Some people compare what's happening today to 2011, when 4 consecutive margin calls shook the market. But the truth is, margin calls are not the main reason silver moves. The real forces behind the market are much bigger, and once you understand them, everything starts to make sense. Before we get into it, if you love following silver and gold, make sure to like this video, comment your silver predictions for 2026, and hit subscribe. We've got a lot of important updates coming, and you don't want to miss them. So, what exactly is a COMEX margin call? Simply put, it's a warning to traders that they need more money in their account to keep their positions open. When this happens, prices can move fast and people often panic. Back in 2011, margin calls did push silver down temporarily, but that was a very different time. Today, the financial system is completely changed. Treasury bonds no longer act like a safe place to park money, and the Federal Reserve is forced to print money just to keep things running. That changes the dynamics entirely. Silver is no longer just a paper market game. Industrial demand, from solar panels, electronics, and new technologies, is consuming real metal faster than it can be replaced. COMEX might move prices up or down, but that is just noise. The real story is physical silver, the metal that is mined, refined, and used in the real world. Looking at history, gold has gone through massive bull markets, sometimes rising 8 times from its lowest point to the peak of the cycle. Silver has not seen that in decades, but now it is beginning to catch up. If silver followed a similar path today, the potential numbers are huge. But the exact price is not the point. The bigger picture is that silver is entering a new phase, a new reality where industrial demand, global physical flows, and scarcity are finally being recognized. COMEX used to be the center of the silver universe. Back in the 1970s and 80s, Western futures markets and a handful of banks largely determined global prices. Today, that is no longer the case. More silver is now being traded physically in Shanghai than on COMEX. Industrial buyers, sovereigns, and refiners in the East are taking delivery and controlling the flow of metal. The paper market in the West is increasingly acting like a pressure valve, not a real driver. When you hear about margin calls, think of them like smoke above a fire. The fire itself is industrial demand, Eastern markets taking physical delivery, and the West's declining trust in paper and fiat currency. The volatility you see from COMEX adjustments and margin hikes is only a symptom, not the cause of where silver is headed. The first thing to understand is that the US bond market, which used to act as a safe haven, is no longer functioning the way investors expect. For decades, people relied on treasury bonds as a stable part of the 60-40 portfolio, with stocks for growth and bonds for stability. Today, bonds are overissued, yields are rising, and even small dips in price can trigger panic. The Federal Reserve has acknowledged this indirectly. A recent statement from the president of the New York Fed, Williams, mentioned that the Fed is ready to buy bonds to ensure liquidity. While he framed it as a routine liquidity measure, the reality is far more serious. This is essentially printing money to prevent the US government debt market from collapsing. It's a signal that the traditional safety net of treasuries is failing, and when that happens, investors look for alternative stores of value, which is exactly where silver and gold come into play. Silver is uniquely positioned because it is not just an investment metal. It is essential for industrial use. From solar panels powering homes in developing countries to electronics and data centers, silver is being consumed at rates far beyond what was anticipated even a few years ago. Meanwhile, the Western paper market, which focuses on COMEX contracts, often gives the illusion of control. People see margin calls or small price swings and assume they reflect supply and demand. But that is a mistake. The real market is physical, and physical silver is being withdrawn consistently. In Shanghai alone, more silver is being stood for delivery in a single quarter than COMEX handled in some entire years of the 1990s. That is a fundamental shift in the market structure. The disconnect between paper prices and physical demand is growing every month. In London and Shanghai, we see backwardation, where spot prices are higher than futures. This is a clear signal that buyers want silver now, not later, and are willing to pay extra for immediate delivery. It is industrial users, not investors, who are forcing this shift. These buyers cannot wait for futures contracts to mature. They need the metal in hand to build technology, infrastructure, and energy systems. That is why margin calls on COMEX, while attention-grabbing, are largely irrelevant. They may temporarily shake speculators, but they do not influence the underlying demand for physical metal. Looking at silver's history, we can see why this moment is unique. Gold has historically had enormous bull runs, sometimes rising eightfold over a cycle. Silver has been capped for decades, stuck in a price range that does not reflect its industrial importance. But now, several factors are converging to create a new reality. The fragility of the bond market, the Fed's willingness to intervene aggressively, the rise of industrial demand, and Eastern dominance in physical silver all point toward a major repricing. This is not a repeat of 2011, when margin calls temporarily disrupted prices. Today, the shift is structural and long-term. China plays a critical role in this transformation. Not only is it the largest producer and refiner of silver, but it also controls a major portion of the global supply chain. Western countries have outsourced refining over the past 25 years, leaving China in control of the choke points. China is now regulating exports strategically, deciding how much metal leaves the country and when. This is not protectionism, it is strategic awareness. Industrial demand in Asia is surging, and the West is learning the hard way that access to physical silver is limited. At the same time, technological growth is accelerating consumption. Solar energy, electric vehicles, and AI data centers are driving demand for silver that cannot be replaced with substitutes. This makes silver fundamentally different from a paper market commodity. Industrial users are standing for delivery, taking metal out of vaults, and creating a scarcity that the paper market cannot reflect. This structural shift ensures that silver's price is increasingly disconnected from COMEX trading and that physical reality will eventually dominate pricing. All of these factors together show why the current volatility is just a prelude to something much larger. The Fed, bond market stress, and COMEX margin calls are temporary signals, but the long-term trend is defined by physical demand and global supply constraints. Silver is entering a new reality where industrial consumption, Eastern dominance, and Western financial weakness will drive prices far higher than most expect, setting the stage for a historic move in the years ahead. One of the most important shifts in the silver market today is the growing dominance of physical trading in Shanghai compared to COMEX. For decades, COMEX was seen as the center of the silver universe. Charts, contracts, margin calls, all of it shaped global perception of price. But today, more silver is being traded physically in Shanghai than COMEX sees in a year. Industrial buyers, sovereign nations, and refiners in Asia are taking physical delivery at unprecedented levels, and that is what truly drives the market. The Western focus on COMEX is largely an illusion, a comfort zone for investors who understand paper contracts but not the actual flow of metal. When physical silver is being withdrawn from vaults and moved to where it is needed, price pressure builds regardless of what margin calls are happening in New York. This shift is especially visible in the backwardation seen in Asian markets. Spot prices are higher than futures prices, signaling urgency. Buyers are willing to pay a premium for immediate delivery because the metal is needed now for real-world applications. Solar panels, electric vehicles, and AI infrastructure are all accelerating consumption. Unlike paper contracts, which can be rolled over or settled later, industrial users cannot wait. If silver is not available today, their projects stall. This is creating structural scarcity that the Western paper market cannot reflect, no matter how much speculation occurs. COMEX margin calls, temporary price drops, and news headlines are distractions. The real market is physical, and the physical market is tightening rapidly. China's role cannot be overstated. The country not only produces large quantities of silver, but also controls a major portion of global refining capacity. For decades, Western nations outsourced their refining to Asia, and now the West relies heavily on China to process metal. This gives China strategic control over how much silver leaves the country, how quickly, and under what conditions. It is not a matter of banning exports, but of regulating them to ensure that domestic and regional demand is met first. As a result, industrial buyers in Asia and other regions with limited access to alternative sources are effectively dictating global physical supply. The West, with its paper-focused approach, is discovering that real silver cannot be conjured from futures contracts when the shelves are empty. Another important factor is that the Western paper market has become increasingly fragile. COMEX contracts are still widely used for speculation, but they are increasingly disconnected from physical reality. Physical withdrawals are accelerating, inventories are being depleted, and forward contracts in London and Shanghai are being stood for delivery. When physical supply cannot meet demand, prices are forced to rise until the market balances. This is not theoretical. It is already happening. We are seeing deliveries on COMEX alone that account for a significant portion of annual mine supply. When the buffers in vaults are used up, the paper market will no longer control pricing. Industrial demand is now equal to or greater than investment demand, and it is relentless. Solar energy continues to grow at double-digit rates. EV manufacturers are scaling production faster than expected, and AI data centers are consuming more metals than most analysts have calculated. Every sector that requires silver is competing for limited supply, and the industrial buyers cannot substitute other metals for their needs. This combination of rising demand and constrained supply creates conditions for violent price moves. COMEX and Western futures markets may temporarily suppress prices with margin adjustments, but these moves will not stop the physical reality from asserting itself. In short, the global silver market is no longer paper-driven. It is industrially and physically dominated, with Eastern markets leading the way. COMEX is still relevant for perception and speculation, but the actual price of silver will increasingly be determined by the physical flow, withdrawals, and industrial consumption. Investors who understand this are positioning themselves for a market that will eventually leave paper speculators behind. The shifts in supply chains, demand growth, and Eastern dominance indicate that silver is moving into a new reality, one where prices reflect the true scarcity and industrial importance of the metal, rather than temporary margin calls or Western speculation. The monetary environment today is unlike anything we have seen in decades, and it is a critical factor shaping silver's future. The US bond market, once considered a safe haven, is increasingly fragile. Treasury bonds are overissued, yields are rising, and even minor price dips can trigger panic. Investors are starting to realize that bonds no longer act as a reliable hedge. The Federal Reserve has openly acknowledged this by stepping back into the market, injecting liquidity, and effectively promising to buy bonds to stabilize prices. While the Fed frames it as a routine measure, the reality is that it is printing money to support a system that is under stress. This action directly impacts silver and gold, because when the traditional safe assets fail, investors seek alternatives that hold intrinsic value, and precious metals become the natural choice. The fragility of bonds also signals a larger structural change. For decades, the 60-40 portfolio model guided investors. 60% stocks for growth and 40% bonds for stability. Today, bonds are no longer stable. They are over-leveraged, tied to government debt that cannot be sustained, and vulnerable to sudden drops. When bonds fail as a hedge, capital flows into assets that cannot be printed, manipulated, or devalued in the same way. Gold has historically filled this role, but silver, because of its industrial and technological applications, is emerging as a critical player in this transition. Investors who ignore silver today risk missing one of the most significant market shifts in years. Silver's supply and demand fundamentals are also responding to these monetary pressures. The Fed's interventions, bond weakness, and the continued decline of trust in fiat currency increase the urgency for physical metal. Industrial buyers cannot rely on paper contracts when inventories are limited. Solar power, electric vehicles, AI data centers, and electronics are all demanding more silver than ever before. This industrial consumption, combined with Eastern dominance in refining and distribution, is creating a structural shortage. Paper market moves, margin calls, or temporary COMEX fluctuations cannot stop the underlying trend. Silver is moving into a reality defined by scarcity and critical industrial use, not by Western speculation. Another factor to consider is how liquidity injections interact with the broader market. The Fed is effectively printing money to stabilize the bond market, but this extra liquidity does not necessarily stay in bonds. Capital seeks higher returns and security, and precious metals benefit from this movement. Silver, in particular, is sensitive to these flows because its supply is finite and its industrial demand is inelastic. Unlike bonds, silver cannot be issued or devalued by policy decisions. This makes it an increasingly attractive asset for both institutional and industrial players, driving prices higher as more participants recognize the risk of relying on paper assets alone. The combination of Fed actions, bond market weakness, and industrial demand sets the stage for a historic shift in silver pricing. COMEX and Western futures markets may temporarily manipulate prices, but they are not the core drivers. Real silver is moving physically, industrial demand is growing exponentially, and Eastern markets are increasingly in control. This structural imbalance means that when the paper market can no longer suppress prices, silver will reprice violently to reflect the scarcity and real-world demand. Investors who understand this dynamic can position themselves ahead of the curve, while those focused only on COMEX charts risk being caught on the wrong side of the market. Finally, it is important to remember that this is not just a short-term rally or speculative spike. This is a fundamental shift, driven by monetary instability, declining trust in fiat, industrial growth, and Eastern control of physical supply. Silver is entering a new reality, where prices will reflect both its monetary value and its essential industrial role. The volatility we see now is just a prelude. The structural forces behind the market are building quietly, but they are unstoppable. Those who recognize this and prepare will have a significant advantage when the market fully adjusts to this new reality. As we reach the final part of our breakdown, it's important to tie everything together and understand what this all means for silver in 2026 and beyond. The volatility you see in COMEX margin calls, temporary price drops, and Western speculation is just the surface. The real forces shaping silver are physical demand, Eastern market dominance, and structural scarcity. Industrial buyers, from solar energy companies to electric vehicle manufacturers and AI data centers, are taking delivery of silver at levels never seen before. COMEX and paper markets are increasingly irrelevant in determining the real price. The more the West focuses on futures contracts, the more it misses the true story. Silver is moving physically to where it is needed most. China's control of refining and exports adds another layer of importance. The country is regulating how much silver leaves its borders, prioritizing domestic and regional needs first. This means that Western industrial buyers and investors are competing for a limited global supply. At the same time, physical withdrawals in Asia and Europe are accelerating, with backwardation signaling urgency. Buyers are willing to pay a premium for immediate delivery because silver is essential for building technology and energy infrastructure. Unlike paper contracts, these are real-world needs that cannot be delayed or replaced. When you combine this industrial demand with monetary instability in the US, bond market fragility, and Fed interventions, you get a perfect setup for a historic repricing of silver. Silver has been caught in a price range for decades, capped artificially compared to gold's historic bull runs. Gold has gone through eightfold moves in past bull markets, and silver is now beginning a similar phase. The industrial and physical demand, combined with constrained supply, means silver could reach levels far beyond current expectations. The Western obsession with COMEX charts and margin calls obscures the bigger picture, but the reality is unavoidable. Once inventories are fully drawn down and the paper market can no longer suppress prices, silver will move sharply higher, likely in a way that surprises most investors. It is important to understand that silver does not trend slowly like gold. It jumps quickly and violently when fundamentals dictate. Mining stocks are another factor often misunderstood. Many investors look at the lagging performance of miners and assume the rally is fragile. In reality, miners always lag at first. Capital flows into the metals themselves before it reaches mining stocks. Once the market recognizes that high silver prices are here to stay, miners will break out sharply. Watching the momentum between gold and the S&P shows that capital is already beginning to migrate toward precious metals, even if mining stocks have not yet caught up. Being prepared and understanding this delay is critical for any investor who wants to benefit from the next stage of silver's move. In conclusion, silver in 2026 is no longer a paper market commodity. It is an industrially essential metal, physically dominated and increasingly controlled by Eastern markets. Volatility, margin calls, and COMEX news are distractions from the real market forces. Structural scarcity, monetary instability, and industrial demand will drive silver prices to levels far higher than current perceptions. Investors who understand these fundamentals, pay attention to physical supply flows, and position themselves accordingly will have a significant advantage. Silver is entering a new reality, one where its industrial, technological, and monetary importance cannot be ignored. Thank you for joining me on this deep dive into the silver market. If you found this analysis useful, make sure to like the video, subscribe to Gold Rush Reporter, and hit the notification bell so you don't miss updates on silver, gold, and mining developments. As a subscriber, you'll also get early access to market insights and price alerts that are not available to the general public. The silver story is evolving fast, and being informed is the key to staying ahead. Stay tuned, stay stacked, and remember, the real silver market is physical, and the future belongs to those who understand it.